Hello learners, I hope you followed the concepts regarding working capital. In the previous two lessons, we have learnt about the concept of working capital as well as the meaning of working capital management. We also learnt about objectives of working capital management. As you know, objective of working capital management is to ensure liquidity and maintain the profitability. That is liquidity profitability trade-off. Therefore, working capital management, the first step in the working capital management is planning for working capital, which means estimation of working capital requirement. So let us proceed further today with the practice as well as concept on estimation of working capital requirement. If you see, the components of working capital are current assets and current liabilities. So the first method, which is traditional method or balance sheet approach method for estimating working capital requirement, is estimation of current assets and estimation of current liabilities. That means in this traditional method, we will be estimating separately each component of the current assets as well as each component of the current liabilities. As you know, current assets are the one which are either in the form of cash or likely to be converted into cash within 1 year, whereas current liabilities are the one which are to be paid off within 1 year. So let us proceed further. So calculation of working capital requirement is basically why we estimate working capital, so that we can achieve a trade-off between liquidity and profitability. Liquidity means ensuring sufficient availability of all the components of current assets so that production and sales activities can continue smoothly. This particularly targets at estimating accurate level of different current assets and then definitely estimating accurate level of current liabilities also. So in this method, we will estimate different current assets and different current liabilities. And as you know, net working capital is difference between total current assets and total current liabilities. So let us move further. Now, moving further, we find that we need to take certain precautions while calculating working capital requirement. Working capital requirement are to be computed with reference to cash cost only. That means to say, we need to exclude the depreciation. Now, why we exclude depreciation? Reason is simple. Depreciation is a non-cash expense. That means it results from only a book entry. As soon as we provide the depreciation, it gets reflected as an expense in the income statement, but we never pay anyone on account of showing the depreciation as an expenses. Therefore, depreciation is not considered while estimating working capital requirement. Hence, what we will be doing, whatever may be the depreciation, rather it may be related to production facilities or it may be related to admin, sales or any activities. For any level, working capital will be excluded. Depreciation will be excluded because we are estimating working capital. And estimation of working capital basically means how much investment is required in the different current assets and how much financing we will have from different current liabilities. And net working capital tells me how much funds are to be arranged by the finance manager to finance a particular level of operating activities from the angle of working capital finance. So depreciation is excluded, and even the debtors are also taken at cost. That means to say profit, because when we sell the goods, an element of profit is there. So that profit we earn in future whenever sales takes place. But while estimating working capital requirement, we are interested to know how much of our money is blocked into the debtors. So therefore, debtors will be at cash cost only. Remember, cash cost. So estimation of different current assets. So the first current asset within the inventory category or stock category is raw material. As you know, if a manufacturing company is there, they procure the raw material, process it and convert that into finished goods. So how much of raw material will be invested or how much of the money will be invested in raw material inventory to sustain a particular level of production? So the formula is clear itself, budgeted production in units. So word budgeted simply indicates how much production we have estimated for a future time period. Then cost of raw material per unit multiplied by average inventory holding period with reference to raw material. Remember, average inventory holding period means simply it may be in days, months or weeks. If it is given 2 weeks, that means on an average company is keeping a stock of 2 months requirement of raw material. If it is in months, then accordingly months. So that is the holding period, it will be given to you. So holding period simply specifies that on an average how many days of the inventory we keep in stock or how many months of the inventory we keep in stock, divided by 12, 365 or 52, depending upon the fact how your average inventory holding period is given. So this average inventory holding period is particularly with reference to raw material. Remember, we are estimating stock of raw material or level of raw material inventory. Then we proceed further, the second part, because inventory might have work in process also. Semi-finished goods. Like when we produce the goods, all the goods never get produced 100% within a year. Certain goods will remain in process. In process goods means the goods in which some work has been done and remaining work will be done in subsequent days, in subsequent months or in subsequent year. So that is the basically semi-finished goods. So how do we estimate work in process inventory? It will have 3 components. Component number 1, raw material, labor and manufacturing overheads. Now labor and manufacturing overheads put together are known as conversion costs. So what is conversion cost? Labor and manufacturing overheads. We feed the raw material and both of these activities convert that into semi-finished and then finished goods. So now simple thing you have to keep into mind, if production continues evenly throughout the year, conversion cost will be taken equal to 50%, else it will be taken 100%. So if by default question is silent, then we assume that production continues evenly throughout the year. Formula is simple, budgeted production in units, estimated work in process cost, which will include raw material and relevant element of labor and manufacturing overheads, either 50% of conversion cost or 100% of conversion cost, depending upon the assumption or the scenario. Then average time span of WIP inventory, work in process inventory or work in progress inventory, whatever you call it as, it may be progress or process, divided by 12, 365 or 52, depending upon how we are given the holding period. So this is the way we estimate WIP inventory. We can proceed further. Finished goods inventory. Finished goods basically means the goods which are ready to be sold in the market. Once these are ready, from the warehouse or from the factory, these will reach to the sales department or for the display purpose. Now, how do we estimate finished goods inventory? It will be budgeted production in units, cost of produced unit per unit, excluding depreciation. So at every level, we have to exclude the depreciation. Now, this cost of goods produced is simply comprising of raw material 100%, labor cost 100% and manufacturing overheads 100%, multiplied by finished goods holding period, months, days or week. So week is not written over there, but yes, sometimes it is given in weeks also, divided by. So this line is basically indicating the division. This line is basically indicating the division. So this particular part is divided by this one, 12, 365 or 52, and that is the way we calculate cost of each unit of finished goods. Then cash and bank balance. So what we have estimated three different inventories: raw material, WIP and finished goods. Cash and bank balance. So companies do keep some cash and bank balance for routine expenses so that they can pay for the routine expenses, as well as some cash is maintained for the precaution purpose or emergency purpose or speculative purpose. So generally, there are three motives of holding cash in a business organization: transaction motive, precautionary motive and speculative motives. So what I told you, there are three motives: transaction motive, precautionary motives and speculative motives for holding the cash. Then we estimate, so in between there will be one more current asset, that will be receivables. So receivables, debtors. Debtors will always be at cost. Remember, if yes, question specifies, the examiner wants that debtors or trade receivables have to be on selling price, then there is no problem. Question is clear. Otherwise, in all the circumstances, in all practical life cases, as well as in default cases, debtors will be estimated at cost only, and that too cash cost. Now, budgeted credit sales, because debtors originate from the credit sales. The moment we sell on credit, yes, debtors will originate. So, budgeted credit sales multiplied by cost of sales per unit excluding depreciation. So, cash cost, it becomes average debt collection period. Average debt collection period simply signifies that on an average, after how many days we collect money from our receivables. On an average, after how many days we collect money from receivables. That is average debt collection period. It will be given to you, divided by, so this is again division function, relevant factor. Now, what is the relevant cost? Point is, what is the relevant cost for estimating cost of debtors or cost of every one unit which has been sold out? It will comprise of raw material, labor cost, manufacturing overheads, administrative and selling overheads. So it becomes total cost of each unit which is being sold in the market, whether you sell it in cash or credit, but total cost will comprise of these four elements. Now remember, again I am telling, we have to exclude the depreciation while estimating working capital requirement. Cash balance we have already seen. So all these four become current assets. Then we estimate current liabilities, because once we have estimated current assets, however, there may be other current assets also. We will deal with that, like prepaid expenses. So they will become also an asset. Right now, proceed further, estimation of current liabilities. Current liabilities are the one which are to be paid off within 1 year. And what are the prominent current liabilities? Trade payables, also known as accounts payable. So accounts payable or trade payables, expenses payable. And apart from working capital needs, the financing, inventory and debtors, firms also find it useful to have some minimum cash balance with them, so that we have already dealt with. Now one thing I'll explain in between. When we finance the working capital, there is a one source called as spontaneous source of working capital finance. By spontaneous source, we mean such source for which we need not to put any extra efforts to get the finance. By your trade behavior, by your goodwill, you will get this finance. And that spontaneous source of finance is trade credit. The moment your goodwill is good, your payment track record is good in the market, suppliers are ready to extend credit to you. So financing by using trade creditors or trade payables is called as spontaneous source of finance. Now, how do we estimate trade creditors? So these trade creditors are with reference to purchase of raw material. However, if you are in a trading business, there is no raw material. You are buying ready-made goods and selling the ready-made goods. So need not to worry. These will be the trade payables with reference to finished goods. So budgeted yearly production multiplied by raw material cost per unit multiplied by credit period allowed by creditors. As we allow credit period to our customers, suppliers also provide credit to us. Therefore, it will be given to you either in months, days or weeks. Divide with the relevant factor. Now point comes, if question is silent, then we consider all the material purchased is on credit. However, question says 75% of the material is purchased on credit and rest in cash. Then how many units will come at this point? Only 75% units. So if we take an example, a company is producing 2 lakh units and 2 lakh units are purchased from the market as raw material, and credit purchase is only for 75% of the component, then 2 lakh will not be used at this place. We will use 75% of the 2 lakh, that is 1,50,000. So you have to take care. However, one more important thing, whether it is purchase of raw material or sales of the finished goods, if nothing is specified in the question, then we assume all the purchase is on credit. Similarly, if nothing is specified about sales, that whether all the sales is in cash or credit, we assume all the sales on credit. So that is our null assumption or default assumption. So this is the way we assume trade creditors, or we calculate trade creditors with reference to raw material purchased. Then wages payable. Wages payable means we never pay wages as and when everyday wages. It is paid at the end of the month. So employees or workers have worked for the month or one fortnight, and then we pay them. So therefore, there is always some time lag. Time lag means delay in the payment of wages. So that will be specified to you. If it is specified, use that. If by default, if you ask me what is the default consideration with reference to wages and overheads, then if nothing is given in the question, if in the examiner has not given anything, then we assume there is no lag, no advance payment. However, question says there is a lag or delay. Lag means it will create current liabilities, and if it is advance payment, it will create current assets. So lag will be given. So budgeted yearly production times labor cost per unit multiplied by average time lag in payment of overheads, and whole of this, again I am telling, this will be divided by the relevant factor 12, 365 or 52. So that is the way we will get wages payable. Then overheads, excluding depreciation and amortization of every kind. So budgeted yearly production, overhead cost per unit, then average time lag in payment of overheads divided by the relevant factor. Now always remember, if lag is not there, question is silent, so we assume as and when it is paid, so there is no current liability, no current asset resulting from overheads and labor cost. If it is given wages is paid in advance, if it is given overheads are paid in advance, so that much component will become current asset. Similarly, important point, when we estimate current assets with reference to receivables and current liabilities with reference to trade payables, always remember, if an advance payment is given to supplier, that will become part of the current assets, or by that much amount trade creditors will get reduced. Similarly, if we receive advance from our customers, credit customers, remember credit customers, then by that much amount our debtors will be lowered, number one, or it will form the part of current liabilities. Either way you can do it. Now once we have estimated all the current assets and current liabilities, so step number 1 was estimation of current assets, step number 2 estimation of current liabilities, then what we are left out with? We have to make this kind of pro forma, and this pro forma will give you how much working capital is required to sustain a particular level of operating activities. We'll take an example also, but if you can take this pro forma for your reference purpose, so you have to make only fill in the blanks. In an examination also, this flow has to be maintained. Now, what is the flow? We have estimated all the current assets, just plug in the values. Raw material, work in progress inventory, finished goods inventory, debtors, then estimation of current liabilities, creditors, wages, overheads, total current liabilities are there. Then we have difference between total current assets and total current liabilities. That means difference between number 1 and number 2 is net working capital. So that is total current assets minus total current liabilities. Again, if in the examination question or in practical life also, some margin for contingency is given. We are given provide 10% or 15% contingency margin. It means company wants to make some provision for the emergency. Number 1, it may be because we are estimating for the future and no one can predict the future perfectly. So some rate might fluctuate. So to keep into consideration or to keep a provision for that fluctuation, we provide margin for contingency or emergency margin. So that will be given. Now this emergency margin will be applied on net working capital. For example, your net working capital is 3 lakh and contingency margin is 10%. Then how much will be the contingency? 10% of 3 lakh, that is 30,000. Now you get your working capital requirement 3,30,000 rupees. So contingency provision is calculated on net working capital. So that is the way we will be calculating it. Now in the next slide, I have kept an example for you. We'll quickly see that example, and this method is very easy. Only the pro forma you have to keep into consideration. What is given? A company is planning to make the working capital estimation for a particular project. Estimate the net working capital required for that project. Add 10% to your computed figures to allow contingency. What we are given? Estimated cost per unit is given. How much is the cost? Raw material 80, labor 30, overheads exclusive of depreciation, that is excluding depreciation. So this 60 is pure cash cost, 170. Now one more trick I will tell you. Since we are given only one single overheads, pay the attention. We are given overheads. No specification whether these are manufacturing overheads, administrative overheads or selling overheads. So by default, we will consider these as manufacturing overheads. So that is default consideration. So total cash cost is 170 per unit. Let us proceed how many units they are going to make. So selling price is 200 per unit. Level of activity 1,04,000 units production in a year. Then we are given holding period of each thing. You can note down the holding period of each thing, like for raw material, WIP. Then one more important thing is given. Assume 50% completion stage with respect to conversion cost. That means when estimating WIP inventory, we will have labor and overheads 50%, raw material will be 100%. Then finished goods stock inventory average level is given, credit allowed by suppliers, credit allowed to debtors is given, all the time periods are given, and minimum cash balance is also given. What is left out? Fill in the blanks in the pro forma. So that is what the pro forma will look like. I'll explain each step. First step, estimate current assets, raw material. We were producing 1,04,000 units. Cost of raw material is 80, and how many weeks was the holding period? 4 weeks was given. So 4 divided by 52. We get it. Our investment in the inventory of raw material will be 6,40,000 rupees. So it is pretty easy if you remember the pro forma, remember the formula. Very well, in a comfortable manner we can calculate it. So it means to sustain a production level of 1,04,000 units, raw material inventory will be 6,40,000. Similarly, work in progress will have all the 3 components. Now you can see how these 3 components are given. Cost of raw material in each unit is 80 rupees. So we have kept 80 rupees because raw material will be 100%. And in the question it was specified labor will be 50%. So labor cost was given 30 rupees per unit. So we have taken 15. And overheads were cash overheads excluding depreciation were 60. So we have taken 30. Now only holding period will be there. So in this case for each component we have estimated how much our money will be blocked in each component of WIP. So these three things put together become inventory of working capital or cost of WIP inventory. Then finished goods stock. Production is 1,04,000 units. Cash cost is 170. 80 plus 30 plus 60. If you remember. And holding period of finished goods is 4 weeks. So 4 divided by 52 because there are 52 weeks in a year. So our investment in finished goods inventory is 13,60,000 for a production level of 1,04,000 units. So these three we have calculated. Then we proceed further. Debtors. Debtors will be at cost. However, selling price was 200, but cash cost is 170. Once again, I remind you, we were given one single bulk of overheads, 60 rupees cash component, but no message was given, no hint was given how much out of that is administrative overheads or manufacturing overheads. So by default, we assume all the overheads are manufacturing overheads. So 170, and we were giving 8 weeks credit. So our investment in receivables is 27,20,000. Now one more thing you can see, we have taken default consideration. We have assumed all the production gets sold out, number one. Number two, all the sales is on credit. So that is the default consideration. So that is our investment in debtors. Cash bank balance was given 25,000. It means if we sum up the total level of inventory, as well as debtors and cash bank balance, we get total current assets 52,45,000. 52,45,000. Then we estimate current liabilities. Now, when we estimate current liabilities, we are given average 4 weeks time period. And again, default consideration. All the raw material is purchased on credit. So you can see 80 was the cost of each unit. 4 weeks credit allowed by suppliers. So 640. So by chance, this 640 and this 640 are same because we have same holding period, same parameters are there. But in practice, it may be different. Then lag in payment of wages, 1.5 week was given and wages was 30 rupees per unit. So we have average investment or average financing, rather I'll say, outstanding wages is there because it is a lag. So average financing from delayed payment of wages is 90,000. So these two were there only. You can precisely see if you want to see what were the holding periods. Just let me take you back to the previous slide. So you can see lag in payment of wages 1.5 weeks. So we have total current assets, total current liabilities. The difference between these two will be net working capital. So my net working capital is 45,15,000 rupees. And in the question we have been given add 10% for emergency or contingency. So we have added 10% for contingency. And after adding the 10%, so this 10%, let me tell you, this 10% has been calculated on the net working capital. So 10% of 45,15,000 is 4,51,500. And finally, we get working capital requirement. So how much working capital we require? 49,66,500 to sustain production level of 1,04,000 units. So this is the way we can quickly and easily estimate different current assets, different current liabilities, and working capital requirement. Now we can use this for our financing purpose. That means we can approach to a bank to get the working capital loan, or we can finance on our own, or something else it may be there. So that is the way we estimate working capital requirement. So in this class, we have learnt about traditional method, also known as balance sheet method of estimating working capital requirement. In the next class, we will learn about operating cycle approach. So we will define what operating cycle is, how working capital is estimated under operating cycle approach. Till then, keep on revising. Thank you.